Hello and welcome to our latest video on the 10 terrible habits that may be keeping you poor. Have you ever thought that no matter how hard you work, you just can't seem to make meaningful progress with your finances? Perhaps some habits or behaviors are keeping you from reaching the financial success you desire. In this video, we met with millionaires and money experts to identify the top 10 habits that could be keeping you poor. We will also share specific measures to help you break those patterns and make wise financial decisions. So, if you want to learn how to take charge of your finances and build wealth, be sure to subscribe to our channel. Number 10. Failing to keep track of cash flow and expenses. Failure to keep track of cash flow and expenses is a risky financial habit that can lead to poor money management and financial insecurity. The quantity of money that comes in and goes out of an individual's finances on a regular basis, such as earnings and expenses, is referred to as cash flow. Overspending, debt, and poor financial decisions can result from failing to keep track of cash flow and expenses. Here are some of the reasons why tracking cash flow and expenses is critical. For starters, tracking cash flow and expenses allows people to keep track of their spending habits and patterns. Tracking one's income and costs provides insight into existing spending patterns and can help find opportunities for improvement. For example, if a person's costs surpass his or her income. Finally, keeping track of expenses and cash flow helps with taxation and budgeting. Tracking spending, in particular, is beneficial for tax purposes when preparing to file annual tax returns. It aids in determining deductibles in order to optimize tax rebates. Tracking spending is also useful for determining monthly expenses and making future budgeting decisions. Finally, keeping track of cash flow and expenses is critical to financial stability and smart money management. Individuals should track their income and expenses on a regular basis in order to meet their financial objectives, prevent debt, minimize financial stress, and make smarter financial decisions. Expense tracking apps and software are widely accessible and offer simple ways for people to keep track of their finances on a daily basis. Furthermore, budget implementation and budget setting. Number 9. Impulsive buying and frequent purchases of unnecessary items. Impulsive expenditures and repeated purchases of unneeded products might jeopardize financial stability and add to financial stress. The impulsive desire to buy something without much thought or forethought is known as impulse purchasing, and it can lead to excessive spending. The term frequent purchases of unnecessary items refers to the purchasing of items that consumers do not require or will rarely use. Here are some of the reasons why people buy impulsively or frequently on unneeded products. The desire to shop is one factor behind impulsive purchases and frequent purchases of unneeded products. Many individuals enjoy shopping, and the prospect of purchasing something new can be exciting. The thrill of finding new items can be addicting, resulting in frequent unneeded purchases. This type of conduct is frequently related with the treatment of. Marketing and advertising are also important factors in impulsive and unneeded purchases. Sales, discounts, and limited-time offers are examples of marketing methods that can generate an illusory sense of urgency. Marketers also create advertising that appeal to our desires, leading us to believe that we require something we do not. This can lead to consumers making rash purchases. Finally, some people utilize impulsive and repeated purchasing of unneeded products to cope with other emotions such as boredom or tension. Shopping and buying goods can feel like an escape from stress or a method to feel better. Unfortunately, this is merely a temporary solution that can lead to long-term financial troubles. Finally, impulsive buying and frequent unneeded purchases might have a negative impact on money. Number 8. Missing payment on bills and debts. Missing payments on bills and debts can have serious implications, such as late penalties, increased interest rates, and credit score loss. Missed payments might jeopardize an individual's ability to borrow money, secure rental agreements, or even find work. As a result, it is critical to understand why these missing payments occur and how to avoid them. A lack of organization or awareness about one's finances can be one of the causes of missed payments. Individuals who do not maintain track of their due dates or balances may make inadvertent payments. They might not have a budget to plan for forthcoming bills or enough finances to make payments. Such persons may forget or ignore paying if an appropriate mechanism is not in place. Missed payments may also be caused by an unexpected job loss or a decrease in income. Employment changes can have a substantial impact on an individual's income and capacity to make payments. It is best to speak with creditors and lenders in such cases to explain the issue. Many creditors may work with clients to develop a payment plan or forbearance options that would temporarily reduce the financial load. Finally, psychological problems such as worry or sadness might impair an individual's capacity to efficiently manage their finances. Paying bills and dealing with debts can be stressful for some people, making it difficult to address the issue head-on. In such instances, professional therapy or financial assistance may be beneficial. Number 7. Relying on credit cards for everyday expenses. Using credit cards to pay for day-to-day expenses, such as groceries, gas, or entertainment, instead of cash or a debit card, is referred to as relying on credit cards. Due to high interest rates, this can quickly lead to a cycle in which people spend more than they earn and carry over a balance each month, which can quickly mount and become unmanageable over time. When people use credit cards for regular costs, they may get the erroneous impression that they have more money to spend than they do. This can lead to overspending and the purchase of items that are outside of their budget. As a result, people may collect more debt than they can afford to repay, resulting to bankruptcy. Number 6. Failing to plan and budget in major expenses, housing and education. Financial issues and stress can result from failing to plan and budget for large expenses. Major expenses can range from purchasing a car to purchasing a home, taking a vacation, or funding college. It is easy to misjudge the full cost of these expenses and end up in debt if you do not have a suitable plan and budget. One of the most common causes for failing to budget and prepare for expenses is a lack of comprehension of the costs. Many people are unaware of all the costs associated with a significant purchase, such as loan interest rates, property taxes, and maintenance fees. Without taking into account all of these factors, a budget might soon become underfunded, resulting in financial issues. Furthermore, people frequently overestimate their own financial status. Also, when planning for a major expense, people should avoid taking out loans or relying on credit cards excessively. Loans come with interest and fees, which can significantly increase the total cost of an expense, making it more expensive in the long run. Credit card companies may also charge high interest rates, which can lead to debt accumulation and negatively impact credit score. Individuals should also use financial planning services or meet with financial professionals to assist them with the budgeting process. Such professionals may assist in the creation of a precise budget, the identification of the best financing solutions, and advice on how to manage funds before and after the large expense. It is also a good idea to set up an emergency fund to help in the event of an unanticipated disaster. Such money should be set aside for actual emergencies and not used for impulse purchases. Finally, failing to plan and budget for large costs can have serious financial effects. A realistic budget that reflects the individual's financial capability and situation is essential. Additionally, avoiding excessive loan and credit card usage and developing. Number 5. Not prioritizing paying off debt. Failure to prioritize and pay off debt is failing to devote a large amount of one's income to repaying outstanding debts such as credit card bills, personal loans, or mortgages. This frequently results in hefty interest charges, missed payments, and debt accumulation, all of which can have serious consequences for one's financial health and future. People who do not prioritize debt repayment may struggle to make the minimal payments, resulting in missed payments and late fines. This, in turn, can have a negative impact on their credit score, making it more difficult to get credit or earn favorable interest rates in the future. Furthermore, being in too much debt might make it difficult to attain personal financial goals such as saving for retirement, purchasing a home, and so on. Number 4. Failing to save regularly. Failing to save on a regular basis is failing to set aside a percentage of one's salary for future use, whether for emergency savings, retirement, or other financial goals. People who fail to save on a regular basis frequently squander all of their income as soon as it arrives or use it to pay off debts without saving anything for their future financial requirements. People fail to save regularly for a variety of reasons, including living over their means, being in debt, and failing to prioritize savings as an important aspect of their financial planning. For some, not having enough money to satisfy their immediate requirements is a huge impediment to consistently saving. Others, on the other hand, may lack the discipline or incentive to save. Number 3. Lending money to friends and family without clear repayment terms and exceptions. Lending money to friends and family without clearly defining repayment terms and expectations might result in financial and personal difficulties. While it may appear to be a good idea to assist a loved one in need, it is important to realize that money can frequently confuse relationships. One of the most common issues that arises when lending money to friends and family without a clear repayment plan is that it is unknown when the loan will be repaid. This ambiguity can produce strain in the relationship since the lender may be unsure when or if they will see their money again. Without written terms, it may be difficult to enforce the agreement if one of the parties breaches it. In addition to establishing clear terms, it is critical to interact with the borrower on a frequent basis in order to hold them accountable for their payment schedule. It is best to set specified payment dates and times, as well as weekly or monthly check-ins, and to always document established agreements and any changes in conditions. Finally, before lending money, be honest with yourself and determine whether you can afford to lend the money. It's vital to realize that no matter how well you know the person, there's always the possibility that the money will never be seen again. Only lend what you can afford to lend without expecting anything in return. Finally, lending money to friends and relatives is frequently done with the finest intentions. Number 2. Ignoring financial planning and budgeting. Ignoring financial planning entails failing to develop a detailed plan including one's financial objectives, income, expenses, savings, investments, and debts. People who do not engage in financial planning frequently lack a clear grasp of their present financial condition or future financial demands, which leads to poor decision-making, overspending, and debt accumulation. One of the most common reasons people disregard financial planning is the notion that they do not have enough money to invest or save. People who do not have a plan may struggle to prioritize their spending and may rely on credit cards or loans to fulfill their expenses, leading to a debt cycle. Another cause for disregarding financial planning is a lack of financial understanding or experience. Many people are frightened by the complexity of financial planning and may avoid it altogether. Number 1. Overspending and living beyond one's means. Overspending and living beyond one's means relate to a financial scenario in which a person spends more than they earn and can afford, resulting in debt and financial instability. This can happen for a variety of reasons, including social status, purchasing superfluous stuff, a lack of budgeting, and bad financial planning. Living beyond one's means can express itself in a variety of ways, such as carrying credit card debt, repeatedly overdrawing a bank account, paying payments late, or taking out unrepayable loans. These behaviors can create a vicious cycle of borrowing more money to pay off previous obligations, eventually resulting in excessive financial stress and more debt. Societal pressure is an important component that contributes to overspending. Customers want to stay current. Finally, if you want to generate money and achieve financial freedom, you must identify and break the harmful habits that are keeping you poor. We hope that this video has assisted you in identifying some of these habits and providing you with actionable methods to break them. Remember, it's never too late to get financial control and make great changes in your life. Pay close attention to these habits and begin practicing the ones that will assist you in reaching your financial objectives. If you like this video, please like and subscribe to our channel for more informative information on financial education and wealth building tactics. Thank you for your time.